Hello and welcome. My name is Jeffrey Kennedy and welcome back to another episode of Elliott Wave Junctures. Today I'm going to be talking about a concept or an idea that's very, very important when it comes to trading, and that is the idea of what is possible versus what is probable. Big difference. Unfortunately, a lot of traders, or a lot of mistakes traders make, is that they trade what is possible and not what is probable. For example, if you can count 5 waves up and done, for example, 1, 2, 3, 4, 5, boom, there's the top, you count the trade, you see prices going down because you can count 5 waves up and done. Essentially, if you take a trade at that juncture, you're simply taking a trade on the idea that it's possible that you have 5 waves up and done. As I say quite often in futures junctures, just because you can count 5 waves up and done doesn't make it so. What you need to do is wait for something which I talk about all the time, and that's called confirming price action. That's what moves a wave count from analytically, or from what is possible, into what is probable. So what we're going to do with this idea is look at a few of the price charts that we've looked at in recent days with respect to Elliott Wave Junctures. Now in this idea, in this price chart here, this is we were looking at some of the key characteristics of counter trend price action. Very simple. It was a price action contained within parallel lines, 3-wave structures, wave equality, or wave equality or 1.382 multiple between wave C and wave A, and slow-moving price affairs. And when I posted this price chart, we were roughly, say, right about here. I think I did this on Monday, and we were essentially had this identified as a wave 1, and this was a subsequent move up as wave 2. Now that's essentially the idea, or that was what was possible at that time. Okay, now at what point did the idea or this wave count move from what was possible into what was probable? Well, initially it would have been, say, a move below here on a closing basis. At that point, you actually have confirming price action, or at least you have price action which is supportive of the overall idea that gold prices are going to move to the downside. Now, once we actually saw that confirming price action, or that close below this extreme here, your initial protective stop most appropriately would have been at this extreme right here. Now, if you're a bit more conservative, you actually may wait for, say, a break of the center line of our corrective price channel. That occurred just a few hours ago. And then at that point, if you had been conservative and even waited simply for a break of the center line of the corrective price channel, then an appropriate area for a protective stop would have been the last little swing high right there. Even if you're more conservative and you still haven't done anything with this position here, you may wait for a closing price action below the extreme of wave B. If you're more conservative, you may even wait for a break below the lower boundary line of the corrective price channel altogether. Even if you're more conservative, you may want to see, say, 5 waves down and then possibly a pullback into the trend line here, and then wait for, this is the IED, what I call sometimes the sweet spot, to take the position. But bottom line, when I presented this chart initially, it was what essentially was possible in gold. As prices began to decline, that's when the analysis, or that's what happened at that juncture, is as prices declined, this idea of a possible decline in gold turned into a probable decline in gold. I like to trade probabilities. I don't like to trade possibilities. For example, is it possible that someday I could become president? Absolutely, that's possible. Is it probable? Absolutely not. It's not probable. That's not where my passions lie. That's the difference, and that's what I'm talking about here. Okay, here's another example in copper. Okay, when we spoke about this, we were right about here. It was on the 18th, I believe, and this was the idea: A triangle BC up and done, looking for a move to the downside. That was what was possible at that time. But when we saw the prices unfold impulsively and then rally in 3 waves and begin coming back down below this area right here, that's what happened. What happened here at that instance with this price decline, number one, by acting as confirming price action, we moved what was possible into the realm of what was probable, and thus we had a viable trade. That's what's important with respect to today's lesson. Here's another example here. We had identified this as an ABC to the downside, identified this as a low, and we were looking for prices to advance. Okay, again, at this juncture, when I first talked about it, identifying this as ABC down and done, that was simply a good idea. That was a hypothesis. That was what was possible. But as prices fell in 3 waves, and subsequently the last last few hours, the last, say, 4 to 6 hours in this market, as we've seen prices begin advancing nicely on a closing basis. Now that we're taking out, the upper boundary line of the corrective price channel, better yet, if we can get prices above this extreme right here, and then keep prices above, say, that 81.5 mark, what we're seeing happen, what we're seeing take shape right in front of us is this good idea, is this hypothesis, is this what is possible moving into the realm of what is probable. Trade what is probable, not what is possible, because many times the reason why is because you'll see exactly what you want to see. That's why you need to wait for the confirming price action and the price evidence. Okay, now let's take a look at some of the things that did not work, and you'll understand what I'm talking about. Remember these price charts here? I was excited about the head and shoulders pattern. Well, in this price chart here, I remember we actually nixed the idea of the head and shoulders pattern in the Dow mini contract, but we did embrace the idea that we actually had a head and shoulders pattern here in the E-mini S&P. And if you recall, we were right about here when we were talking about the head and shoulders pattern. Here was the left shoulder, here was the head, here was the right shoulder. Okay, well, that was possible at that time. It was very possible, which is exactly why I spoke about it and talked about it. But what happened was it never increased in probability. Number one, we did get below the center line of that head and shoulders channel, but we never broke below the neckline, which is really what we needed to see to clear the way for a move all the way down to the neckline measurement, which was roughly about here. In other words, by not seeing this price action right here, we were not able to move this market from a possible good trade to a probable good trade. Moreover, whenever we started breaking above the upper boundary line of this trend line right here, once we started punching through that, then what that actually did was greatly decrease the probability of this actually being a head and shoulders, and that's the difference, and that's the distinction. Here's another example. We looked at the possible head and shoulders here in the E-mini NASDAQ. Okay, it was very nice and very possible at again the head and shoulders formation right here when we began to see prices turn to the downside. This was encouraging price action as well, seeing movement below the center line of the head and shoulders channel, but we never got below the neckline there. Thus, we were never able to turn a good idea into a good trade. Moreover, whenever we came down and began advancing back up above this area right here, that essentially negated the idea that this was indeed a head and shoulders. Moreover, we saw the same thing here in the Russell as well. Again, think of it this way. At this juncture over here, we have the left, okay, just pretend the price action to the right of my pencil here has yet to form, okay? At this juncture, this is a good idea. This is what is possible, i.e. the head and shoulders pattern. Here's my left shoulder, here's my head, here's my right shoulder, here's my downward sloping trend line. Now, I could be somewhat eager and go ahead and take a short on the position in anticipation of a move to the downside down to the neckline measurement, which would be about, say, 710 or say maybe even 705. That being the case, where am I wrong? Well, if we get above the extreme of the right shoulder, so there would be my initial protective stop. Does the risk-reward ratio pan out? Is it better than 1 to 3? I don't know. We'll have to do the math on that. But at this point here, I believe I do have an opportunity. This is what is possible. But to turn it into the realm of probabilities, or what is probable, we really need to take out that neckline. Okay? Well, look what happened subsequently. Okay? Well, I'm not seeing supportive price action. I'm not seeing confirming price action. And really at this point, when prices get back above this extreme, it's best to simply abandon the idea that this is indeed a head and shoulders and think that something else is actually forming. Now at that point, I most likely would have drawn a corrective price channel right here and just went ahead and thrown the idea out the window with respect to the head and shoulders pattern and simply viewed the move to the downside as an impulse wave, and I would be looking for a trading opportunity roughly about here. So at this point, I still like the idea of a short, but we got to get back below, say, maybe say 758 here. We got to get back below that swing low, because thus far this is a nice impulsive decline followed by what appears to be a corrective advance. But again, what's possible and what is probable are different. As we can see, as prices move, we go higher, come back down, but still we reverse and continue on higher again. So again, confirming price action is what is important. Confirming price action is what takes a good idea, what is possible, into what is probable. And from a trading perspective, I always recommend trading what is probable. Thank you.